Today I want to talk about two stocks that pay a high dividend yield that I think may be good investments that are reasonably valued right now. The first one is Home Depot. The second one is Broadcom. Both of these stocks have a growing dividend and they've paid a dividend over a long period of time. If you like content like this, please make sure to like and subscribe. It really helps the channel out. Both Home Depot and Broadcom can be found in the Schwab US Dividend Equity ETF. They both are top holdings. You can see them right here on the first page. Broadcom and Home Depot. And I'd also say you could probably add Texas Instruments. It's a bit of a toss-up between Texas Instruments and Broadcom for the tech part. Let's do some research now using the Fidelity website for Home Depot. So you can see here the price earnings ratio is 17.28. The stock price peaked out around 346 back in December of 2022, and then it's peaked out again around February, and then it's dropped since then. It's down about 16%, I believe. Now, if we look at the Home Depot's price earnings ratio, it's 17.29. Now, the 5-year average for Home Depot is 21.74, so it's selling below its average PE ratio. The average for the industry is 19.6, so it's below the average for the industry. The earnings per share growth rate, trailing 12 months, 7.4%. The industry average is down. Here you have a fundamental analysis. Valuation. Now, this is showing overvalued, but if you look at some other places, you'll see that it shows undervalued. It shows quality as being high, growth stability, medium, financial health, sort of medium. Okay, here you can see the earnings per share growth over the last 5 years has been 18% a year. Industry average is 18.45%. Profit margin, 33.53. Industry average, 35.37. But the after-tax margin is much higher at 16.83 versus 14.5 for the industry. Okay, Fidelity also has, if you click under more stats, you can also find some details like price to cash flow, price to sales, trailing 12 months. Here we can see the revenue growth the last 5 years is 9.3%, so pretty good. Cash flow growth the last 5 years, 13.38%. That's pretty good. Here you can see the competition. The closest competitor is probably Lowe's. If you look at the price earnings ratio, now they're using an estimate, which I don't really like because this is not a real number. This is a made up, a forecasted number. They're showing that Home Depot is going to be slightly more expensive than Lowe's. Okay, now Fidelity has this nice CompuStat report. I really like these reports. They're very useful. Now you'll see how useful it is here. So you can see the details here as far as earnings per share growth the last 4 quarters, 7.5%. Sales growth. Now this it's only showing 0.3%. I believe the last quarter was a little bit low. Current ratio 1.3. Current debt to equity 14,000. They must really have the equity very low. Debt to CapitalOne. Okay, now if we go back, we can see the year-by-year price earnings ratio. So you can see that in 2015, Home Depot was selling at 23 times earnings. It's 18, 22, 22. So its current price earnings ratio is not too bad. The price to sales has been around 1.8 to 2.5. 2.5 in 2021. Price to cash flow has been around anywhere from 15 to 19, around 15 to 20, and it's currently, I believe it's around 17 now. Sales per employee, 330,000, so it's moving upwards from 2015, from 229,000 to 331. Return on equity has gone up quite a bit, from 111%. I believe there was some negative equity here, which means they're buying down a lot of the shares. That's why you get this negative value. Return on assets, all pretty good. The dividend yield has been increasing from 1.9% to 2.3%, and I believe it's about 2.7% now. Here's the price earnings ratio. 17 for Home Depot, 19 for Lowe's, so Home Depot's looking a little bit better. Now if we start comparing here, we look price to sales. Home Depot's 2.1 price to sales. Lowe's is a little bit cheaper at 1.3. But you'll see the reason why. Home Depot's better in a lot of different ways. Here's one, return on assets. Home Depot's 22.4% return on assets versus 14.7% for Lowe's, so Home Depot's more profitable. Return on investments, Home Depot's 34, Lowe's is 29. Gross margin, Home Depot's 33, Lowe's is 31. The operating margin, Home Depot's 15.3, Lowe's is 11.2. So once again, Home Depot's more profitable. Here's the net margin, Home Depot 10.9, Lowe's 6.6. That's a big difference there. Here we have sales growth, annual sales growth. Home Depot's 4.1, Lowe's is 0.8. So Home Depot wins on that one too. Current ratio. This is assets compared to liabilities. The higher the current ratio, the better. So Home Depot's 1.4, Lowe's is 1.1. So if a recession hits, Home Depot will be able to pay off debts easier than Lowe's will. Total debt to equity. This is not so important now because Home Depot's been buying down so many of their shares that their equity's next to nothing now. All right, now here we have a comparison of market cap. Home Depot's worth almost 3 times as much as Lowe's, $294 billion. Home Depot has $157 billion in revenue versus $97 billion for Lowe's. As you can see, the revenue growth is better. The 1-year earnings per share growth has been better with Home Depot. The profit margins. The profit margin for Home Depot is not too bad for the other industry. It's not as high as O'Reilly and AutoZone, but those are completely different business. It's not as good as the makeup business, but it's better than Tractor Supply. It's better than a lot of these companies. Here you can see Home Depot's dividend payment history. You can see back in 2015 it was 59 cents a share. It's gone up every year and now it's $2.09 a share. Here you can see there's basically an upward trend every year with the revenue. It's gone from $88 billion to $157 billion. Gross profit's gone up from $30 to $52 billion. If you look at the earnings per share, it's also gone up. Earnings per share has gone up from $5.4 to $16.74 per share. And if you look at the shares outstanding are declining, which means Home Depot's buying back shares. 1.2 million shares back in 2015. Now they only have 1.02 million shares. Here we can see the cash flows for Home Depot. So the operating cash flow from the business has gone from $9.3 billion to $14 billion. It's gone up pretty much every year. Now, actually, 2020 it jumped up quite a bit, and then but that was an unusual year. Here's a site that I like to use sometimes. It's called Guru Focus. Now, I like to use their discounted cash flow calculator. That's the DCF calculator. Okay, so what this discounted cash flow calculator does is it takes the future stream of earnings per share and it discounts it back to the present to figure out this value. So you just put in the ticker symbol. It'll calculate what it believes the fair value for a stock is. So for Home Depot right now, it believes that the fair value is $521 and the stock is selling for $289. So there's a margin of safety of 44%. Now you can play around with this. You could also use the free cash flow. It's actually using the earnings per share 10-year data, which is 18.6, which is higher than the 5-year. So I would probably lower it a little bit. So, and it's using this, and it's using the most recent trailing 12 months earnings per share, which is 16.68, and you can see that right here. Now you could lower this if you wanted to. So if you wanted to sort of lower the starting point, you could make it, let's say 15. You could make it $15, and it's still a 38% margin of safety. Now, if we use the free cash flow value, it's showing that there's not a margin of safety. It's using the 14.2% free cash flow growth rate. Now, there's more that you can look at here. So you could see they break this all down into per share values. So you can see the 10-year revenue growth rate is 12%. The 5-year revenue growth rate is 13.3%, and then this last year, it's dropped quite a bit. Things are slowing up, 7.5%. Now, this NRI means, this EPS with NRI means non-reoccurring items. So this would be like a special expense. That's the earnings per share data they're using. You can see that the dividend growth rate, the 10-year dividend growth rate was 20%. The 5-year growth rate is 16%. We also can compare Home Depot to its competitors, such as Lowe's. Home Depot has a 17 price earnings ratio, and Lowe's has almost a 20 price earnings ratio. And you can also see price to sales, price to book. Margin of safety for Lowe's is 42%. The margin of safety is showing that it's higher for Home Depot at 44%. Above the discounted cash flow calculator, you can also download an Excel spreadsheet, and you can modify this if you want to do more calculations on your own. Okay, here's the spreadsheet example for Apple. So you could actually change the ticker symbol. You could put in your growth rate. If you subscribe to their premium service, I believe all this data will be filled in for you automatically. I have a referral link that I'll put in the description where you can sign up for Guru Focus, and you'll be able to do some of these more advanced things if you sign up. Okay, so what do I think of Home Depot? I think it's reasonably priced. I probably wouldn't buy it at $289, but probably when it gets closer to $275, I'll probably maybe start adding some. Here you can see a quick run through. This is quite surprising seeing this. Their sale, this is from 2021, but I'm a little bit surprised. Appliances are 9% of their business. There's no one business that really dominates. The garden is surprisingly high, 10%. So paint is only 6.9%, flooring 6%. So there's no one category that really dominates. They're fairly well diversified. So even though we're going into a recession and they're definitely going to be impacted, people are going to cut back on projects. They're probably going to do smaller projects. People are still going to be buying things. They're still going to be buying paint. They're still going to be doing small projects. They'll still be doing gardening. Maybe they'll cut down on the appliances and the larger ticket items, but I still think they're going to do fairly well. So even though it may go down, the stock may continue to go down a lot like it does usually after I buy. I think it's a good one for the long term, and it's a business that I understand. So I'm definitely probably in at $275 for me. The next stock that I want to look into is called Broadcom. Now it's the number one holding of the Schwab US Dividend Equity ETF. It has a price earnings ratio of 21, which isn't too bad. It has a dividend yield of 2.91%, which is pretty good. And it's been paying a dividend yield for a while, even with all the acquisitions. If we look at the 5-year chart here, you can see that it peaked out around 2021, around 682. And it's selling at 630.97. And it went down to around 420 in October of 2022. Here under fundamental analysis, it shows the undervalued, overvalued, and it's actually more on the undervalued side. The quality is showing fairly high. Gross stability, they're actually showing this quite high. Gross stability, they're showing this much higher than what Home Depot was at. Financial health, it's in the middle, just sort of like Home Depot was. Here's a 1-year earnings per share growth, 69.38% growth. That's pretty impressive. The 5-year growth average is 45%, and it's got a whopping 76% gross margin. Return on equity is a very high 57%. Return on assets 17%. The income revenue per employee is really high, 1.7 million. Income per employee 629,000. Now they do have some debt. Debt to assets 68%. Net sales 8.9 billion. Okay, they're comparing this to a bunch of different companies here. Now their estimate for the price earnings ratio is 15, which is pretty low. I guess they're expecting the earnings to come in high. If you compare it to Intel's at 54 now, which is quite high. Let's look at the CompuStat report for Broadcom. 3-year earnings per share growth 60%. Sales growth 15%. Total debt to equity 180%. Current ratio 2.4. That's pretty good. I don't like the debt to equity, looks a little high, but we'll have to look into that. Okay, here's the price earnings ratio. 2015 it was 24. 2017 it was 65. It's been all over the place. It was 7.8 in 2018, 55 in 2020, 35 2021, 17 now, 17 in 2022. Price to sales is around 5 most of the time. Price to book value is around 3.4 to 8. The gross margin has been actually increasing. It's from 63% to 76%. That's a good sign. Sales per employee has been increasing. Return on equity has been increasing from 29% to 49%. Return on assets Still good, 13%, 15%. The dividend yield has been increasing from 1.3% in 2015 to 3.5% in 2022. If we do a comparison between Broadcom and Texas Instruments, Broadcom has a slightly higher PE ratio, 21 versus 18, but it has a lower price earnings growth ratio, 0.3, because the growth rate of Broadcom is much higher than Texas Instruments. Texas Instruments is 0.8. If we look at the price earnings ratio, it's not the highest, it's not the lowest. It's sort of in the middle. The same with the price to sales. It's not the most expensive stock here. The price to book, it's sort of in the middle. So nothing that's showing that it's really overvalued. Return on equity is 49%. Texas Instrument is even higher at 60. Return on assets, Texas Instrument is even higher at 32. But the growth on Broadcom is better. Gross margin for Broadcom is 76% versus 73% for Texas Instruments. Texas Instruments has a 51% operating margin, which is higher than Broadcom. Now the net margin, you can see at one point Broadcom had a higher net margin than Texas Instruments, but now more recently Texas Instruments had a 43% net margin, which is still very impressive. However, now when we look at the sales growth, you'll see that Broadcom is a little bit better. Broadcom has a 21% annual sales growth versus 9% for Texas Instruments. And when it comes to annual earnings per share growth, Broadcom had a 76% increase in earnings per share growth versus 13% for Texas Instrument. The stock performance for Broadcom has been better than Texas Instruments also. Texas Instruments is in red below. The blue is Broadcom. This one above it is AMD. Okay, here, how does it compare to the other semiconductor stocks? Broadcom is the third largest here for market cap. It's listed as being worth $263 billion, but Taiwan Semiconductor, TSM, and NVIDIA are larger. TSM also had good revenue growth, but Texas Instruments, 1 year revenue growth, 9.2. It's about half. The earnings per share is much lower, but somehow they still have a good profit margin, Texas Instruments. Okay, their earnings per share have been kind of all over the place. It's basically an upward trend though. So 2018, they had quite a bit of a jump and then it dropped down. Okay, so the Huawei ban was in 2019. May of 2019 is when it started. They lost $2 billion in sales at that point. So you can see that the earnings from 2018 to 2019, the earnings per share dropped from $28 to $6. But you can still, if you look at the start of 2015, it was $5 a share earnings. And you look to currently, it's $26. So it's still an upward trend, quite a bit of growth. Now here's the dividend payment history. This is what's quite interesting about Broadcom is unlike most tech companies that don't pay much of a dividend, Broadcom is a high growth company that's been acquiring other companies for lots of money. And they've got an acquisition right now for, I think it's $62 billion for VMware. It hasn't been approved yet. It still has to be approved. And they also tried to acquire Qualcomm, but that acquisition failed. And that was a multi-billion-dollar acquisition too. But according to the CEO, they still plan on continuing to pay dividends even with the acquisitions. So that's part of their strategy. They're going to find a way to pay the dividend even with the expensive acquisitions. Now you can see that the dividend yield, the payment history, the per share value of the dividend has gone up quite a bit. Now the dividend yield peaked out around 2020. That was probably when the share prices were lower. Okay, now let's look at the sales. From $6 billion to $33 billion. That's quite a bit of growth. Now it's going to be kind of hard to figure out the sales because they have lots of acquisitions. That's why they have these abbreviations for, they restated it when they have an acquisition. So it's probably more useful that we look at the per share value. But if we look at the gross profit, it's went anywhere from $4 billion to $25 billion. Okay, net income, they had a loss in 2016, but the net income's gone from $1.3 billion to $11 billion. It's been a little bit rocky. The diluted earnings per share went from $5.7 to $27 a share. That's quite a bit of growth. If we look at the receivables, nothing too crazy. It doesn't go up or down too much in any 1 year. Inventories, nothing too crazy. It did go up a little bit in 2022. They have quite a bit of debt. Their debt, long-term debt, went from $3.9 billion to roughly $40 billion. Now, they had some debt that was tied to Prime, but it looks like they've cleared it out in the last couple of years. Here you can see all the cash dividends that they've paid out each year. Gone up each year. $7 billion this most recent year. Their operating cash flow went from $2.3 billion to $16 billion. If you look at the capital expenditures went from $593 million, and they're basically $430 million every year. They're not going up like a company like Intel or AMD probably has. So this is probably a company that doesn't spend a lot of money on new products. They're probably just trying to maximize their current profits. But instead, they spend the money on acquisitions, as you can see here. I guess this is what these analysts say when they suck the blood out of a company. I guess this is what they mean here. When you see that the capital expenditures are not growing, if they're acquiring all these new companies, these numbers should be going up, but they're probably cutting back on the expenses, and that's why these numbers stay low. Okay, now for the discount cash flow calculator for Broadcom. So if we look at this, it's showing that the fair value, it's actually using, there was an issue with the 10-year, that year where there was that loss messed this up. So we're going to have to use the free cash flow values, which shows a 39% growth rate, which is pretty high. Using the free cash flow growth rate, it's showing that there's a 52% margin of safety, that the stock should be worth $1,367. So that's a pretty good margin of safety there. And it says here, your expected free cash flow growth rate 8.9 could be achievable. Expected 10-year free cash flow growth is less than the historical 10-year free cash flow growth rate of 39.6%. And if we look here, you can see that the operating income went up. Per share operating income, the 10-year went up 31%. The earnings before interest and taxes went up 33%. Book value 22%. Revenue 24% 10-year. Unlike Home Depot, this is a company that's fast growing and they have to issue shares. So the shares are actually increasing in number. They have to issue new shares to acquire companies and so forth. Now here you can see the comparison. Price earnings ratio of Broadcom 21, Texas Instruments 19. Price to book, they're very similar, except the growth rate on Broadcom is a little better. Now it's showing that the margin of safety is minus 73, but that's because there's not a value on that 1 year. But Texas Instruments is also showing a very good margin of safety. So that one's probably not so bad either. And here you have Qualcomm. So what do I think about Broadcom? Well, the company right now has some very impressive growth rates. And I don't quite understand what their main product line is. From what I understand, there's chips that they sell for Wi-Fi, like the latest Wi-Fi chips, and for cell phones. Both Samsung and Apple are big customers, according to their CEO. I watched a video of him. Apple is planning on making their own chips and not using any Broadcom chips in 2025, I believe. Broadcom's definitely going to take a hit then, which isn't so good. Now, the other one, Texas Instruments. Texas Instruments was mentioned several times for the auto chips shortage. And because of the auto chip shortage, they were able to produce chips because there was a shortage from China or Taiwan. Because of that, their stock price went up quite a bit. So I think now that that's sort of settled, that's going to probably go. Texas Instruments going to probably take a hit from that a little bit. So I still think I prefer Broadcom because it's a higher growth. They buy these companies and then they focus all the money and efforts to the businesses that are doing well. And then they take the money away from the areas that aren't doing well, or they divest. They spend less money on capital expenditures than a company that supports all their products. So they're not going to support all the products when they acquire a company. If it's a weaker product, unless the customer absolutely needs it, then they'll support it. But they try to maximize the use of their money to the most profitable products. Okay, so what do I think of Broadcom? It's still fairly reasonably priced at 21 times earnings. So at the current price of $637, it's probably an okay buy. I do have some concerns though. I looked at their financial statements, and if you look, about 80% of the revenue is products and then they list the other one as subscriptions. And I tried to find out where their product revenue comes from, which particular products, because I want to know how they're impacted by the Apple's going to stop taking their chips in 2025, and so that could impact their revenue. And then if Apple does it, it's possible Samsung may do the same thing and start making their own. Then if they lose Samsung and Apple, how much of a loss is that? So that's what I have a question about, and I haven't been able to find the answer. So I don't quite understand their business, so I'm hesitant at this point. Here you can see the revenue by segment. You can see that semiconductors make up the bulk of their revenue, and then they have infrastructure software, which makes up a smaller portion. And with the VMware acquisition, that's going to be different. So VMware is mostly software. So their software revenue should go up after the VMware acquisition if it goes through. Hopefully it'll make up for any shortfall from the Apple cutting the business off with them. But they don't list the customers here. I don't see the particular products listed here. So I don't know how much revenue Apple is or Samsung. And that's a little bit concerning. But if you can put that aside, it's reasonably priced, and they have growth like Cisco used 2 years ago. So that's definitely a good thing. Thanks for watching. Please make sure to like and subscribe and press that notification bell so you'll get notified of new content.